Let's turn our attention to business at home now, and particularly rates, the prospect of a change. Joining us is Stephen Koukoulas from Market Economics, the Chief of Market Economics. Tell us, Stephen, most economists saying that the RBA won't move. They want to see the impact of the 3 recent rate cuts wash through the economy first. Is that your sense?
Yeah, I think so. And even though the numbers that we've seen on the economy just in the last week or so have been a bit disappointing, I think the RBA are talking about a gentle upturn in the economy. They're detecting it in things like private sector business investment, exports, which are still doing quite well, infrastructure spending, which is also strong. So at the moment they're on hold. There's almost no chance that they'll move today. There's still a possibility that they'll cut again early in the new year if the economy doesn't get that momentum that they're hoping for. But for now, with the economy muddling along, doing okay, they're probably just on hold and wait and see how those rate cuts that we saw in the last 6 months kick in.
And by the beginning of next year, we'll have a much better sense if the retail spending picks up, because it hasn't in the wake of those tax cuts like we thought they would.
Yeah, they were disappointing numbers yesterday, to be honest. We had the prior month in August, I think it was, showing an increase of 0.4%, which isn't bad. So the market was expecting another 0.4, 0.5. So it only came in at 0.2. Now, it doesn't sound like a big difference, but when you're talking about economic growth being between 3 or 2 or even 1.5%, those couple of decimal points make a big difference. So there was a bit of disappointment there. And look, consumers are still cautious. There's evidence that they're actually using both the interest rate cuts and the income tax cuts that we saw earlier this year to reduce their debt. So credit card balances are falling. People are sort of being a bit cautious, not spending and paying off.
So in the longer term, that's a good thing, isn't it?
It is.
We've got enormous household debt levels.
We have high household debt, so in a sense it's sort of quite logical for consumers to do that they're sort of perhaps reassessing their financial position, thinking, gee, I've got a lot of debt here.
The December quarter you would think would pick up, but with Christmas, maybe people are holding out for summer as well.
Could be. So there's a whole lot of influences coming in here, and in fact the curious thing too is the increase in house prices over the last 4 or 5 months. In fact, since the election, house prices are up about 5%. So that wealth effect's going to be powerful too. People feel a bit better, they're more inclined to spend. So the jury's out. I think we're just going to have this pause until we can have a complete reassessment on the economy.
So tell us the significance of not moving the inflation target, because it seems like that could have been quite significant today. It
could have been, yes. So look, in a sense, adjusting the inflation target would have been a real signal to the financial markets about whether RBA should be hiking or cutting rates, in fact. So in a sense, if you'd lowered the inflation target, we'd already be in the middle of the target. So in fact, the next move in rates could be up, heaven forbid. So I think Frydenberg did the right thing in a sense in terms of not adjusting the inflation target. It would have been a controversial decision. Slightly disappointed that they didn't do what the Reserve Bank of New Zealand did, and that is perhaps have a higher profile for the unemployment rate, because we've got unemployment at 5.2%, still a little high, and as we were just saying, wages growth is very weak. So it would have been nice perhaps to have the unemployment rate on the same status as the inflation target. But look, it's business as usual, I guess, from that agreement between Mr Frydenberg and the RBA.
And it seems a compelling argument from the Treasurer to keep things as they are, because if you look around the world, low inflation is basically everywhere across the advanced economies. And the other point, that Governor Lowe makes a lot is that he has flexibility within his remit. So
he does.
It's not like it's an iron
or electric fence, you get to 3 or at 2 and you've got to adjust rates instantly, because again, and the reason for that is Australia's openness, I suppose, and openness to terms of trade and commodity price changes makes it very volatile. So if the price of iron ore or oil prices, because of some shock in the Middle East, cause our inflation rates to change, of course the RBA shouldn't adjust to each little quirk in the numbers. So since that flexible target's important, but we've got to remember we've been below the bottom of the target for 4 years now, and so that's why the market's still flirting with the idea that there could be another rate cut in the next few months.
So does this mean that we're much further away from any discussion of quantitative easing if we're not looking at a rate cut now, if we're looking at perhaps iron ore holding up?
Yes, it looks like we've moved away from that for now. Look, you never say never, but it is still I won't say a remote possibility, but it's unlikely. The economy isn't that bad. When you look at when quantitative easing's been implemented in the US, in the Eurozone, in Japan and other economies as well, it's because their economies are really in severe trouble. We're not in that state at the moment. We're weak, we're soggy or subdued in terms of economic growth. It would require a downward shock from here for QE to come through.
And it's interesting at a broader level, a regional level, we're seeing after the wave of protectionism from Donald Trump to Brexit, now this major deal, the Regional Comprehensive Economic Partnership,
yes,
15 countries, even in a strategic or mindset sense, that pushes back against that protectionism.
It does push it, and that's the good news about the trade agreement. Look, it's very hard to sort of work out what the value will be to the region and to Australia in particular from the trade agreement, but they're generally good. Look, they're not the sort of thing that's going to cause people to come out and say, look, Australia's economy is going to be stronger on the back of it, but you'd prefer to have freer trade than the stuff that we've seen between the US and China. So to that extent, and given that Australia has roughly 3/4 of all its exports going to the Asian region, it's a win for us.
Andrew Lee was on Sky News this morning. He was saying that there is benefit to agreements like this, but multilateral, bilateral agreements are also more powerful. Do you think that that's true?
Look, I think so. Look, we want free trade around the world. So the biggest multilateral free trade agreement would be everybody being on board. But yeah, with the US and China sort of moving away and still have got the tensions, and we don't know how that's going to pan out in the election year for the US next year, but we'd prefer to have multilateral, all-encompassing free trade agreements, because that has, despite the criticism of neoliberal economics over the last few years, that has helped bring people out of poverty. It's helped to see the global economy grow faster than it would otherwise be. So we prefer that style of free trade agreements. Look, we'll take every bit we can get. Baby steps in the right direction are still in the right direction, but we prefer sort of a more encompassing freer trade pact.
And finally, Annalise touched on it earlier, but with iron ore, resources prices holding up, the budget right now, as we head into the mid-year economic update,
yep,
it's looking quite good, isn't it, in terms of the government meeting that commitment,
yes,
which many people would argue is more a political commitment than
sure,
a budget one, but that surplus, they're going to get there, aren't they?
Putting the politics aside for the moment, the numbers look as if that $7 billion surplus that they were forecasting back in April, when the budget was brought down then, for 2019-20 financial year, looks to be broadly on track. We've got offsetting things. The economy, yes, it's a little bit weaker. Wages growth is weaker than they're assuming, so that costs revenue. But as you touched on, even though iron ore prices have come off in the last couple of weeks, they're still above $80 a tonne. Yep. They assumed 55, well, so that's giving them a bit of a revenue windfall. So you balance them out, we're broadly on track, but we'll see it all in May.
Indeed, we will, not far away. Great to see you, Stephen. Thanks so
you.
much. We'll talk to you.